China and Russia have just slammed the door on the US dollar. This isn't speculation or some future strategy, it's happening now. Oil, minerals, and microchips are being traded in rubles and yuan. Meanwhile, Washington is demanding that China open its markets. But American exporters are already in trouble. Small businesses are closing. And across Asia, central banks are sitting on a $2.5 trillion time bomb. And it's ready to go off. Trump says tariffs give the US leverage. But what if they're actually doing damage from the inside? Wall Street's already been shaken, and your job could be next. You can't ask to be let into someone's house while locking your own doors. Yet that's exactly what the US is doing. Washington wants better access to Chinese markets, while enforcing a massive 145% tariff wall that's choking off Chinese imports. This isn't theory, it's real. As of May 2025, importers must charge $18 just to break even on a $10 product. Trump's team argues it's about getting the best deal for America. But the US keeps asking China for major concessions while offering fewer in return. Even though exports to China still total more than $140 billion and support over 500,000 American jobs, this imbalance isn't improving. It's getting worse. And here's the irony. If US leaders truly believe that access to China's market is vital, why make American products more expensive and less competitive? This isn't just weakening the US negotiating position, it's hurting American businesses before the talks even begin. At the ports of Los Angeles and Long Beach, shipments from Asia are down nearly 40% year over year. But don't assume China's taking the same hit. It's not. April 2025, trade data shows Chinese exports to the US fell 20%, but their global exports grew 8.1% in dollar terms. They've simply rerouted shipments to Southeast Asia and Europe, both of which saw double-digit increases. And this pivot wasn't random. China's been reshaping supply chains since 2023. While the US tried to freeze Chinese factories with tariffs, China quietly found new buyers. So did tariffs really pressure Beijing, or just redirect its exports to friendlier markets? If China can reroute global trade this quickly, who's actually more dependent on whom? China didn't respond with threats, just a 125% tariff on US goods. Then it walked away. The result? US shipments to China plunged. American brands like Apple, McDonald's, and Starbucks are watching their presence shrink in cities they once led. According to S&P data, American companies earned over $1.2 trillion in revenue from China last year. That's 4 times more than the US trade deficit with China. But Chinese consumers are already moving on. Local brands like Luckin Coffee are challenging Starbucks in Tier 1 cities like Beijing and Shanghai. Huawei is regaining ground, eating into Apple's market share. This isn't just competition anymore. If the trend continues, US brands risk becoming irrelevant in the world's second-largest economy. So here's the key question. Can US exporters survive this slow freeze-out? Or is Beijing quietly shutting the door on one of America's most valuable markets? This could be the moment everything changes. Washington points to falling trade as a strategic success, proof that it's putting pressure on Beijing. But what if it's not pressure? What if it's self-inflicted damage? Back in May 2025, US Treasury Secretary Besant met with Chinese officials in Switzerland. Trump called it a very good meeting, but nothing came of it. No agreements, no frameworks, just silence. Meanwhile, back home, small businesses are struggling. Companies like WSM in Massachusetts and local florists in Kentucky report delayed shipments, canceled orders, and spiking costs. WSM lost $16 million in expected retail contracts, and now has $500,000 in merchandise stuck at Chinese ports. If this is what victory looks like, it's ignoring the flashing warning signs. Because when your supply chains collapse and your exporters fail, maybe it's not the other side that's blue. This spring, Russia and China made it official. Nearly all of their trade is now settled in yuan and rubles, not dollars. This includes oil, gas, metals, and critical industrial components. Their goal? To build a system immune to US sanctions and dollar dominance. As of April 2025, over 50% of China's total trade is settled in non-dollar currencies. And the numbers don't lie. According to SWIFT, the yuan now accounts for 4.3% of all cross-border payments, up from just 2% in 2021. But this isn't just about money, it's about trust. A currency only matters globally if people use it and believe in it. China and Russia are building financial systems that no longer need the US dollar at all. So the real question is, a financial time bomb may already be ticking. Economist Stephen Jen recently revealed that exporters from China, Taiwan, Vietnam, and Malaysia have quietly built up over $2.5 trillion in US dollar reserves since 2020. But that stockpile is becoming unstable. After a round of US-Taiwan trade talks, Taiwan's currency surged 8% in just 48 hours, its biggest jump since 2007. That triggered a ripple across Asia. Other currencies rose too. At the same time, the US dollar index fell by 9% in 2025 alone. Now traders are, well, bracing for what Jen calls a non-linear sell-off, a scenario where countries start dumping their dollar reserves all at once, not out of strategy, but out of fear of being the last one holding a sinking asset. This isn't just market noise, it's a structural shift. The Fed is expected to cut rates by 75 basis points this year. Meanwhile, dollar-based assets are seen as overvalued. It's a dangerous mix. Now, Asian central banks face a tough choice. Start quietly selling off dollar reserves or risk being crushed in a panic exit. Either way, the global financial map could be redrawn. And honestly, the long-term fallout hasn't even begun. Back in Massachusetts, WSGCO has $500,000 in stranded goods and just lost $16 million in retail deals. In Oklahoma, 4K9 can't bring in dog seat covers, even as demand grows. In Michigan, Lisa McDonald's tea shop, which relies on premium Chinese leaves, says she's just weeks from being priced out. Different industries, same message. Help isn't coming. These aren't global giants with deep safety nets. They're lean American businesses being crushed by policies that just don't answer their calls. Tariffs are hitting smaller firms hardest. Multinational corporations can reroute supply chains, but local companies can't rebuild decades of sourcing overnight. Officials like Basant say the U.S. is still the top investment destination, but small businesses are folding before that investment ever reaches them. So what happens when the very economy Washington wants to protect can't survive the protection? Even if a new deal is struck, the tariffs are here to stay. Trump is pushing for a permanent 10% baseline tariff on all imports, even from allies. That doesn't just target rivals. It adds cost to every part of the United States supply chain. The Kiel Institute says this policy would cut United States exports by 17%, leaving American producers to either eat the costs or lose global market share. Meanwhile, China and its allies expect just a 5% drop, easily absorbed thanks to lower costs and leaner margins. So the country pushing hardest for new trade terms is also making its goods the least competitive. And with tariffs baked into nearly every product, from parts to consumer goods, the industries they were supposed to protect are being pushed out of global markets. Maybe this isn't even about economics anymore. Maybe it's about If China pulls back, Wall Street could follow, and the dollar might stumble. If Chinese buyers stop purchasing United States goods, the impact will be fast and painful. In 2024, the United States exported $140 billion in goods and $46 billion in services to China, supporting nearly 900,000 jobs. California alone sends $15 billion. Texas sends $21 billion. But the bigger risk isn't trade, it's the markets. According to S&P Global, United States companies generate about 7% of their revenue from China. If that vanishes, so do forecasts, dividends, and investor confidence. When Wall Street drops, so does the dollar. Demand for United States stocks and bonds is built on stable growth. Take China out of the equation, and you don't just miss targets. You shake the entire financial foundation. Investors won't wait for confirmation. They'll exit at the first hint of instability. So ask yourself, can the United States keep the dollar strong while forcing its top trading partner to walk away? This isn't just a tariff dispute anymore. It's the slow unraveling of the global trade model built since the 1990s. China has rerouted exports, ditched dollar settlements, and doubled down on yuan-based trade. Russia has cut out the dollar entirely. Asian exporters are preparing for a post-dollar world. And while Washington says its markets are open, its tariff policy says otherwise. Small businesses are collapsing, Wall Street is exposed, and the dollar is starting to crack under pressure. These tough-looking trade policies, they might actually be dangerously weak. So think about it. If the dollar no longer holds global trade together, does the United States still hold global power? And what happens to every retirement fund and business loan built on the idea that the dollar always wins? Thanks for watching. If you found this valuable, subscribe and check out the next video on your screen.